In most companies, achieving business growth is left only to marketing and sales functions. Unfortunately, both of those disciplines are inherently tactical and may not contribute adequately to a company's strategic growth objectives. Companies can improve their future growth prospects by adopting a fundamentally new business logic, or science of growth, which views sustainable business growth and value creation as a function of time, space, and source. By considering the time, companies can deliver short-term growth while simultaneously considering medium and long-term growth. With the space dimension, companies can expose adjacent and entirely new growth markets. By exploring new sources of growth, companies are able to create unique combinations of value propositions that drive growth. With 6 key principles that are part of the 18 growth thinking principles of growth, companies can take practical steps to implement this new science of growth. Starting with Principle 7, Mind the Growth Gap, companies can address the inevitable gap that develops between planned growth targets and the actual ability to deliver those targets. Under this principle, companies map their real growth trajectories and strategically align their risk tolerance and actual sources of growth to close the gap. Principle 8 advocates that companies think like venture capitalists to break through dominant operationally focused behaviors to focus on the high growth, investment return, and value creation outcomes that distinguish good growth strategies from bad. Me Too thinking and decision-making leads to reactive, Me Too growth strategies. Principle 9, Individualize Your Growth Formula, suggests that dramatically higher growth outcomes are possible from more independent growth strategies that leverage the unique strategic assets, value propositions, and offerings of individual companies. Just as investors diversify to the best risk-reward ratio, under Principle 10, Think in Portfolios, companies must build growth portfolios as a collection of opportunities, value propositions, and business models that address growth objectives within the company's capacity for risk. With Principle 11, Focus on Speed to Value, adding speed to value to the more traditional metrics of risk tolerance and resource availability can help companies realize the powerful high growth potential and network effects of first-mover advantage. Finally, with Principle 12, Measure for the Future, companies are able to use forward-looking indicators such as market attractiveness, growth posture, and business model power, which are far more important to delivering growth than historically significant but inherently trailing indicators such as profitability, costs, and earnings per share. Ultimately, the dimensions of time, space, and source, along with the 6 principles that support them, work in concert to help companies implement a new science of growth that reveals new growth opportunities in existing, adjacent, and white space markets over the short, medium, and long-term horizons.